They'll check on whether simple technical trading strategies rules can outperform a passive buy and hold strategy. So I will be showing you my muted HTML report, which contains all the code analysis and results for the SPY from January 2018 to December 2024. So technical trading strategies are systematic approaches to investing that uses historical price data and statistical indicators to forecast future price movements and generate buy and sell signals. So unlike fundamental analysis, which looks at companies' financial health, technical analysis focuses solely on the price patterns, trends, and market behavior. So common technical indicators include moving averages, which help identify trend directions, and the relative strength index or RSI, which then measures the momentum and identifies overbought or oversold conditions. So why do investors compare technical analysis to buy and hold? So the buy and hold strategy is this passive investment approach where an investor purchases an asset and holds it for an extended period regardless of market fluctuations. So this strategy is based on the efficient market hypothesis, which suggests that consistently outperforming the market through timing is very difficult. So comparing technical trading strategies to buy and hold addresses this fundamental question in finance: that can active management add value over passive investing? So this comparison is important for four reasons. First, active trading incurs transaction costs that passive strategies avoid. So second, technical strategies require constant monitoring and time commitment. So third or lastly, technical strategies may offer better protection during market downturns. Fourth, investors need to know if active trading actually justifies its cost. So let's go down to the methodology. So I use the daily adjusted closing prices for SPY, which is the S&P 500 ETF from January 1, 2018 to December 31, 2024. So I chose this asset because it represents a broad market benchmark and is commonly used in passive investment strategies. I computed daily log returns for all strategies. Moving average crossover strategy. So this smooths price data by calculating the average price over a specific number of periods. So it helps identify trend direction by filtering out short-term fluctuations. So for this strategy, I use the 50-day fast-moving average and a 200-day slow-moving average, as per given as the example. So the buy signal occurs when the 50-day SMA crosses above the 200-day SMA, which is then called a golden cross and indicates a bullish trend. So this sell signal occurs when the 50-day SMA crosses below the 200-day SMA, called the death cross, which indicates a bearish trend. So I applied a lag to trade at the next day's open to avoid look-ahead bias. So RSI strategy naman. So the relative strength index strategy measures the magnitude of recent price changes to evaluate the overbought or oversold condition. So RSI values range from 0 to 100. So I use a 14-day RSI with an oversold threshold of 30 and an overbought threshold of 70. The buy signal occurs when RSI falls below 30, indicating an oversold condition where the asset may be undervalued. The sell signal occurs when RSI rises above 70, indicating an overbought condition where the asset may be overvalued. So when RSI is between 30 and 70, we simply hold the previous position. So the benchmarking strategy. So this benchmarking strategy, you buy the asset at the beginning of the period and hold until the end of the month or end with no trading. So the performance evaluation metric for this is that I evaluated each strategy using three metrics. Cumulative returns measures the total growth of $1 invested over the entire period. The Sharpe ratio measures the risk-adjusted returns using the formula mean return times 252 divided by the standard deviation times the square root of 252. So the higher Sharpe ratio indicates that the better return per unit of risk. Maximum drawdown measures the largest peak to throw decline and indicates downside risk, and capital preservation. So for the code and implementation, so the load libraries, I loaded the required packages, including the quant mode for downloading TTR, Zoo, ggplot, and DPLR. So for the data download and the preparation, I downloaded the data from Yahoo Finance and get symbols function. So I extracted the adjusted closing prices using the add function, which accounts for the splits and the dividends. So I computed the daily log return using the ROC function with continuous compounding. So then created the data from the dates, prices, and log returns. So for the first strategy, moving average crossover. So for the SMA strategy, I calculated the 50-day and 200-day simple moving averages by using the SMA function and the TDR package. So I generated buy signals when the 50-day SMA was greater than 200-day SMA and the sell signals otherwise. So I applied a lag to avoid lock ahead bias, meaning trades occur at the next day's open. I also counted the number of trades by detecting changes in position. So strategy 2, the RSI strategy. So for the RSI, I calculated the 14-day RSI using the RSI function, generated the buy signal when the RSI was below 30, sell signal when RSI was above 70, and hold signal when RSI was between 30 and 70. I used forward filling from the Zoo package to maintain positions between signals. Again, I applied a lag to avoid lock head bias. Buy and hold. So the buy and hold benchmark. Oh, that's the start of this. So the buy and hold benchmark simply use the log returns as the strategy returns since we are always invested. So to calculate the strategy returns, you multiply by position by the log returns or remove the initial NA rows where indicators were not yet available and computed the cumulative returns using the exponential of cumulative sums starting with $1 invested. Finally, I created a results data frame for analysis. Okay, results and discussion. So looking at the cumulative returns. Looking at the cumulative return, starting with $1 invested, the buy and sell hold strategy ended at approximately $2, $2.12, representing a total return of 112%. So the SMA crossover strategy ended at approximately $1.98, representing a total return of 98%. So the RSI strategy ended up at approximately $1.95, representing a total return of 86%. So the cumulative returns plot shows that the performance of all three strategies over the time, and the black line is the buy and hold, the blue line is SMA crossover, and the red line is the RSI strategy. So you can see that during the COVID-19 crash in March 2020, all strategies experienced significant declines, but the SMA crossover strategy recovered more quickly. So the buy and hold strategy consistently led in total returns throughout most of the period. So for the Sharpe ratio which measures risk-adjusted returns, the SMA crossover strategy achieved the highest value of 0.706, followed by buy and hold at 0.679. So and the RSI strategy of at 0.566. This indicates that the SMA crossover strategy provided the best return per unit of risk. For maximum drawdown, which measures the largest peak to trough decline, the SMA crossover strategy had the lowest drawdown at negative 28%. So the RSI strategy had a drawdown of negative 31%, and buy and hold had the largest drawdown at negative 34%. So the drawdown plot shows that these declines over time. The biggest drawdown occurred during the COVID-19 crash in March 2020. The SMA crossover strategy successfully reduced the impact of this downturn by exiting the market before the crash. So this is the primary benefit of technical strategies. So which strategy? Yeah. So which strategy performs the best? So the answer depends on your investment goal. So if you want maximum total return with no effort and no transaction cost, buy and hold is always the best. It achieves the highest total return of 112%. But if you want a better risk-adjusted returns and protection during the market downturns, the SMA crossover strategy is the best. It provided the highest Sharpe ratio of 0.706 and the lowest maximum drawdown of negative 28%. So do trading rules add value? So for this specific period, the SMA crossover strategy added value by providing better risk-adjusted returns and lower drawdown. So this suggests that technical rules can help investors avoid major market downturns. However, they did not achieve higher total returns than buy and hold. So important considerations included the transaction costs, which are included in the analysis, which are not included in the analysis. The SMA crossover strategy required 12 trades compared to 0 trades for buy and hold with even small transaction costs. The return of technical strategies would be reduced. So additionally, past performance does not guarantee future results. So to summarize the findings, this analysis evaluated whether simple technical trading rules can outperform a passive buy and hold strategy using SPY data from January 2018 to December 2024. The key findings are as follows. First, the buy and hold strategy achieved the highest total return at 112%. Second, the SMA crossover strategy provided better risk-adjusted returns with a Sharpe ratio of 0.706. Third, the SMA crossover also had the lowest maximum drawdown at negative 28%. Fourth, the RSI strategy underperformed both alternatives. So does active trading outperform passive trading? The answer is no for total returns. For the specific asset and the time period, the passive buy and hold strategy achieved the higher total returns rather than technical strategy. So, however, the answer depends on the investor's goals. So, for maximum total return, the buy and hold was superior. For risk-adjusted returns, the SMA crossover added value. For drawdown protection, the SMA crossover provided better downsides. So, for the final verdict, is that for long-term investors in broad market ETFs, a passive buy and hold strategy remains the compelling approach due to its simplicity. However, the cost and strong total lower the cost and the strong total returns. So, however, risk-averse investors seeking to mitigate downside risk might find value in incorporating moving average crossover signals to avoid major market downturns. So, the limitations of this analysis includes that transaction cost and the slippage were not included, and only one asset and time period was tested. So, parameters were not optimized, and past performance does not guarantee future results.